Texas didn't just cool off, it lost its fuel. Domestic migration dropped 62%, and with it, the high-budget buyers who made bidding wars a lifestyle. Now, inventory is exploding. 123,237 active listings by April 2025, and sellers are sitting longer, cutting faster. Today, we're counting down 10 suburbs that went from red-hot to price-cut battlegrounds. Before I show you how the buyer pool thinned, why days on market are up, and how a 17.7% overvaluation meets a stalled demand engine, please take a moment to like, turn on alerts, and subscribe to this channel so you don't miss any videos such as this one. If you think this is just about interest rates, you're not ready for what's next. Number 1, Round Rock, Texas. Round Rock was the poster child of spillover wealth from Austin, until the high-budget buyers ghosted. During the boom, it felt automatic. Tech relocations set the tone, pandemic-era bidding wars added the soundtrack, and families sprinted for new construction with the Great Schools badge. You'd tour a home and the agent would already have 3 escalation clauses warming up in the car. New builds? People lined up for release days like it was a sneaker drop. But here's the catch. Domestic migration into Texas drops 62%. The big budget Californians stop showing up, and the spillover money that floated offers 15, 20 grand over ask, gone. The math flips fast when the easy out-of-state cash isn't there to be the final bid. You can see it in the builder behavior. Waitlist turned into, what do you need to make this work? Rate buy-downs pop up first. Temporary 2-1s, then permanent buy-downs if you push. Closing credits appear like party favors. Backyard upgrades get thrown in. Extended patios, sod, even sprinklers if you ask twice. It's not generosity, it's absorption strategy. The data backdrop is loud. Inventory across Texas hits 123,237 by April 2025, and days on market creep up around Austin area suburbs, lengthening roughly 31% year over year in pockets of Travis and Williamson. Round Rock rides that wave. Longer marketing times, more price checks, fewer clean first-week wins. You feel the drag on every showing. It's like throwing a party after the DJ left. Lights still on, nobody dancing. Sellers keep the balloons up. Buyers scroll the playlist and bounce. Why now? Corporate hiring slows. Remote work perks shrink. That classic no state income tax pitch lands softer when stock grants are lighter and HR is tighter on relocations. The once reliable flow of transfers into Austin's orbit thins. So Round Rock's feeder pool does too. Sellers still try to anchor to 2022. They pull those comps, set the number, and hope someone panics. Buyers don't. They run today's payment at today's rate and walk, even with a $10,000 fridge package thrown in. And when a house sits, the next listing copies the discount, then adds a buy down, then nudges the list. It's a slow staircase down, not a cliff. And the market prefers it that way. The tone shift is real. Fear of missing out turns into fear of overpaying. Escalation clauses get replaced by inspection credits, and can you cover title? You'll still see a clean, well-priced home move, but the definition of well-priced got recalibrated by the new buyer pool, not the old fantasy. If Round Rock lost its whale buyers, wait till you see its neighbor that built for them. Number 2, Pflugerville, Texas. Pflugerville used to be the affordable compromise. Now it's stuck in the middle with shrinking buyers on both sides. First-timers priced out of Austin came here for newer builds, sidewalks, and HOA pools that looked like resort trailers. You'd get a decent yard, a floor plan that didn't feel like a tunnel, and you could still hit downtown without sacrificing your entire weekend to I-35. It was the value move. But here's the catch. Higher payments crush the entry tier, and the 62% drop in domestic migration starves the move-up tier. The folks who might have sold in Austin or Round Rock and stretched for a nicer Pflugerville 2-story, fewer of them, less equity sloshing around, and way less urgency. That missing demand shows up everywhere. Sellers who priced with 2022 comps are getting the email nobody wants. We need to talk strategy. Inventory builds. Starter homes that would have been gone in a week now sit next to mid-tier spec homes with flags, balloons, and a salesperson offering points like candy. The street looks busy. The activity is thin. Statewide inventory surging means local competition turns ruthless. Price cuts aren't a shock anymore. They're the pre-game. Concessions go from rare to routine. Builder credit for closing costs. Rate buy-downs as the headline. Sellers covering title to keep the deal from wobbling on week 3. It's all leverage math. Here's a clean example. List a tidy 3-bed at $425,000. In this market, it can sit 45 days, 50 days, 60 if the number misses the payment target. You don't see bidding wars. You see, can you cover the inspection items in 2 points? That's the new script. Payment shock is the silent bouncer. Knock 50 grand off the list and your monthly can still be higher than in 2021. Let that sink in. Rates change the buy box more than price drops can fix, so qualified buyers go surgical. They'll wait for a buy down or they'll sit out. Investors sniff around because they always do when DOM stretches. But rent growth isn't generous, and HOAS plus taxes make the spreadsheet squeak. The cap rate romance dies fast when the monthly nut includes a pool fee and a tax bill that eats your cash flow like it's a hobby. So here's the thing. Pflugerville turns into a pricing lab. Sellers who adjust quickly get movement. Those who cling to nostalgia watch days on market balloon, then cut again, then finally add concessions to catch the buyer they lost in week 1. Clean, move-in ready still wins, but only at a number that respects the new payment math. If the middle is stuck, what happens in the growth frontier where new roofs stretch to the horizon? Number 3, Leander, Texas. Leander scaled for a migration boom, and then the crowd didn't show. You saw the plan. New master planned communities rolled out like a product launch. Pools, trail networks, clubhouses with Wi-Fi and cold brew. Even the commuter rail talk added shine, as if you'd glide to downtown and back like it's a theme ride. The sales centers ran weekend traffic like festivals. Expectations locked in. But here's the catch. Without the inflow of high-budget buyers, supply outruns demand. The models assumed a steady stream of wealthy newcomers. The 62% drop in domestic migration broke the conveyor belt. Spec homes stack up like unsold SUVs on a dealer lot. Every block has another quick move-in sign. The vibe shifts from scarcity to clearance. Builders pivot fast when absorption slows. Lotteries vanish. Discounts slide in. Then come rate buydowns headlined on every flyer. A 2-to-1 temporary if you're timid. Permanent buydowns if you push. And the swag catalog grows. Free fridge plus blinds. Garage door openers. Backyard sod. Sometimes a washer dryer if you ask with a straight face. It's not kindness. It's inventory control. Regionally, the warning light is on. Travis County sits around 3.1 months of inventory, hinting at rising supply across the metro. Leander often runs hotter because it's jammed with new builds, which magnifies every demand wobble. More options appear on your search results each week. The algorithm becomes your best friend, pinging you with fresh price cuts like sales at a sneaker app. Here's the real pain point. A 2,500 square foot new build doesn't move unless the price undercuts 2022 resale comps. Fancy backsplash won't save it. Buyers scroll right past unless the monthly hits their target with the buy down baked in. List high, get crickets. Trim, maybe get a showing and a low offer with closing costs on top. That's the migration trap. Growth plans were priced on endless inbound wealth. When that stream thins, the math collapses. Appraisals start lagging the list prices while incentives try to bridge the gap. Lenders see the buy down and ask where the real market is. Meanwhile, buyers wait. They've learned the game. End of quarter equals deeper cuts. Let that sink in. You get the tug of war. Appraisers protect the comp set. Builders throw in perks to avoid straight price slashes that nuke values. Buyers time the cycle and refresh the listing page like it's a stock chart. It's real. It's happening. Mini payoff. Leander flips from low choice to over choice, showing slow. Leverage swings to the buyer holding pre-approval and patience. Price discipline wins, not glossy brochures. Head north, where history meets new construction and momentum quietly evaporates. Number 4, Georgetown, Texas. Georgetown sells lifestyle. Historic square, big porches, golf carts. But lifestyle needs buyers. For a while, it worked flawlessly. Retirees love the slower pace and the 55-plus setups that feel like a country club without the dress code. Remote workers jumped in too, betting on space over commute. The formula was clean. Quiet streets, trails, and just enough dining to make weekends easy. But here's the catch. Investment portfolios softened, rates stayed high, and inbound wealth cooled off. That luxury light band, nice lots, upgraded kitchens, not quite trophy, now hesitates. People who could write a quick offer last cycle pause, pull up rate calculators, and decide to wait a quarter. Momentum loses steam when the cash buyer turns into the cautious browser. Taxes don't help. Higher assessments landed while affordability fatigue set in. You feel it in the email from the lender and in the HOA meeting, where everyone whispers about the new bill. Would-be buyers do the math and decide the porch swing can wait. They'll hold cash and watch for a better entry. The broader backdrop adds pressure. Statewide inventory hit 123,237 active listings in April 2025, a 53% jump over the 2017 to 2020 average, and more than tripled the 2021 to 2022 lows. That signals less competition. In the Austin orbit, days on market stretch, and Georgetown takes its share. Sellers don't get week 1 fireworks, they get "we'll circle back." Take a stone front 4-bedroom. In 2021, it would have sparked a line out the door. Now it racks up saves on the apps and a weekend's worth of showings, then silence. Not because it's bad, because the monthly payment doesn't land. Buyers wait for a cut or buy down headline. Here's the thing, domestic migration slowing removes the top tier bids that set the comp ladder. Without those anchor offers, pricing loses its ceiling. The gap between list and what buyers will tolerate turns into negotiation reps. Credits for rates, appliance packages, even prepaid HOA stubs. Staging still matters, but incentives move the needle. Sellers try to anchor high and test. Reality answers in steps, not free falls. 10 grand down, another reduction, then a credit to hit the payment target. It's a dance around perception. Price too fast, you leave money. Price too slow, you age the listing and invite lowball season. So Georgetown shifts to negotiate or stagnate. The homes that move have surgical pricing and clean incentives baked in. The ones holding out live on the market long enough to become case studies. It's like running a farmer's market at noon in July. Everything looks great, but buyers only grab what's cold and priced right. Now let's jump to DFW's Trophy Suburbs, where the top shelf buyers powered the entire storyline. Number 5, Frisco, Texas. Frisco was the VIP lounge. Now the velvet rope is just for show. For years, the formula was bulletproof. Corporate relocations fed the pipeline, elite schools kept the family demand steady, and the pro sports glow made every listing feel like a premium ticket. You could list on Thursday, host a quick open house, and field 3 clean offers before your latte cooled. That swagger built the comps and the culture. But here's the catch. With a 62% slide in high-budget migration into Texas, the premium buyer pool that used to set the pace thinned out. The auction energy faded. The top of the market needs a certain kind of checkbook, and fewer of those checkbooks are flying in with relocation packages and stock-heavy down payments. So listings stack. The overconfident price points linger. Days on market stretch on anything that assumes 2021 rules still apply. Those cash-heavy out-of-state wins? Scarcer. When they do appear, they don't chase. They negotiate. The whole tone moves from "how high" to "show me value." There's a bigger layer too. Texas reads about 17.7% overvalued relative to income and rent trends. And Frisco lives on the pricey edge of that curve. That's a polite way of saying the margin for error is thin. The moment demand blinks, aspirational asks don't hold. And sellers feel the air pocket. Executive homes see the widest price discovery gaps. You list at last year's fantasy. Showings dribble in. Feedback sounds like a group chat. Great house, wrong number. Sellers keep channeling the old psychology. Offer deadlines, no lowball language, stiff counters, and watch buyers ghost after the first weekend. Then comes the payment calculus. At today's rates, the buy box is ruthless. A $1.2 million ask becomes $1.05 to get looks, $950,000 to spark movement, then $899,000 when reality taps you on the shoulder. It's not about ego, it's about the monthly. Buyers run the math on their phones and make decisions in under a minute. Let that sink in. Agents pivot to defense. Pre-inspections to kill surprises. Seller paid rate buydowns to hit the target payment. Title credits, repair escrows, and warranty sweeteners so nobody gets cold feet at underwriting. The listing copy reads like a coupon sheet because that's what calms nerves when the comps don't support the dream number. So here's the thing. Frisco's playbook changes from any price, any day to right price or no play. Clean houses still move, but only when the ask fits the new math and the concessions are lined up like runway lights. Get it wrong, and you're teaching a course in patience while the DOM counter climbs. And if Frisco is blinking, the next suburb built on family-sized optimism is feeling it too. Number 6. McKinney, Texas. McKinney thrived on move-ups. Sell in Plano, stretch here. That ladder is missing rungs now. Families used to flow in waves. You'd sell a smaller house closer to 75, grab an extra bedroom and a game room out here, and trade a few minutes of commute for a bigger yard and a newer roof. Subdivisions filled fast because the plan made sense. Better schools vibe, neighborhood parks, and enough strip center convenience to keep your weekend simple. But here's the catch. The pipeline of high-wealth newcomers thinned, so the backfill collapsed. Sellers can't leap if no one is buying their first step. Chains break, a listing that should trigger 2 more just sits, and that pause multiplies across the map. You feel it in the feed. More active listings, slower turn, fewer quick wins. The sticky zone is brutal. Between $450,000 and $700,000, buyers get choosy and payments bite. You can throw in quartz, fresh paint, and a smart thermostat, but the monthly still hits harder than it did. Upgrades don't overcome the rate reality. So the mid-tier stalls while sellers test last year's numbers and get soft feedback. Statewide inventory expanding gives buyers the upper hand, and McKinney wears that shift on its sleeve. Days on market stretch across the popular DFW suburbs, and the gap between list and close gets wider. The tone changes from right tight to right smart, with credits and buy-downs doing the heavy lifting that price alone won't. Now, the rough edges matter. Homes needing cosmetic work crawl. Buyers want turnkey pricing without paying a turnkey premium. They'll nitpick floors, cabinets, and the yard like it's a home show, then ask for a concession stack that covers rate points and inspection repairs. If the house can't deliver a clean monthly, it waits. The migration trap shows up in the vibe at showings. Fewer multiple offer weekends. More second looks followed by inspection cancellations because leverage came back. The urgency is gone, and with it the tolerance for do-it-yourself later. People would rather skip than settle. Here's the thing. Appraisal gaps that everyone waved through in 2021 vanished. Lenders call the shots again. Underwriters want the comps to line up, so creative pricing meets hard limits. That makes sellers even more dependent on buy-downs and credits to hit the target payment without detonating the appraisal. Mini payoff. McKinney turns into a sequencing lesson. Fewer fresh buyers at the bottom means slower exits at the top. If you're selling, you need surgical pricing on day 1 and a concession plan ready by day 3. Clean, updated, and honest about value beats test and hope. And if the ladder's wobbly here in Prosper, it was designed for people who just stopped arriving. Number 7, Prosper, Texas. Prosper banked on top-tier relocations. The pipeline quieted, but the houses stayed loud. New schools, wide streets, and model homes that smell like quartz and fresh drywall. Prosper built a showroom for high earners. Massive lots, tall ceilings, kitchens that belong in appliance commercials. It's trophy home central by design, and for a stretch the demand matched the marketing. But here's the catch. With a 62% drop in domestic migration into Texas, the whales stopped swimming through. The buyers who wrote quick offers with relocation packages and stock-heavy down payments aren't landing as often. Builders and sellers shift to defense. Incentives everywhere. You'll see rate buy-downs printed in bold on flyers, closing cost credits surfacing in the first conversation, and free blinds becoming a punchline. So inventory sits longer than people expect for a prestige suburb. The luxury light segment, call it $800,000 to $1.2 million, starts to look crowded. Not because the homes got worse, but because competition spreads qualified buyers thin across nearby options. The same buyer who once would have begged for the corner lot now takes a slow lap and waits for a cut. Research gives the green light for price moves. With Texas overvaluation estimated around 17.7% versus income and rent trends, there's room to chop without torching the market. Absorption slows when the cash-rich out-of-staters fade, and the days-on-market counter tells the story. Sellers feel the silence and reach for the concession menu. Here's a clean example. A $1 million ask that would have flown in 2021 now nudges to $949,000 to get traction. Then into the high 800s with a seller-paid buy-down to nail the monthly. You're not giving the house away. You're trading sticker pride for payment reality. Buyers don't care about the list price romance. They care about what hits the bank account on the first. The real twist is the buyer avatar shrank overnight. Fewer relocation packages, fewer big equity rollovers. That means slower absorption because the product was built for a specific wallet. It's like stocking a store with designer sneakers when the crowd wants running shoes. The shelves look great, they just turn slower. And the all-cash mystique? Thinner. Fewer tech equity cash outs means fewer offers that waive everything and close in 10 days. Financing is back in the driver's seat, and underwriters don't buy the dream brochure. They buy comps and math. Mini payoff. Prosper moves from aspirational pricing to surgical pricing. Smart sellers front-load concessions. Price to the payment and clear. The rest? They workshop their copy while the DOM climbs. Next door, Selena scaled even faster. Now it's a test of patience. Number 8, Selena, Texas. Selena tried to speedrun suburbia. The market just tapped the brakes. Drive past the new rooftops and you'll see the thesis in 4K. Explosive lot development promised a city in a box. Future retail, shiny schools, and master-planned everything. Streets sprouted cul-de-sacs like they were on sale. The bet was simple. Build fast, sell faster, and let the next wave of high earners keep the carousel spinning. But here's the catch. With fewer high-wealth newcomers landing, the spec pipeline outran the buyer pool. Models look flawless, but the traffic counts don't back it up. You get open houses with fresh cookies and a guest list of 2. The absorption rate slows and the whole machine grinds. Builders don't pretend. Inventory stacks. Rate buy-downs stop being a perk and become the headline. You'll see flyers that lead with points, not paint colors. Closing credits show up early, and those design center upgrades morph into freebies to save the deal. It's not generosity, it's survival mode. The statewide backdrop tells you why this is happening. Active listings hit 123,237 in April 2025, a 53% jump over the 2017 to 2020 average, and more than triple the pandemic lows of 2021 to 2022. That surge means buyers have time and sellers have neighbors they're competing with. Selena mirrors that vulnerability because it's heavy on new builds. When demand blinks, supply stares back. On the ground, it looks like this. Quick move-ins multiply. The same plans sit on 3 different streets. Options and upgrades, extended patios, glass shower enclosures, appliance packages become lifelines tossed in to hit a monthly payment target. You'll hear, "We can cover 2 points in your fridge, mail," before you've even measured the pantry. Here's the thing. Domestic migration was the demand engine. Without that steady inflow of high-budget arrivals, velocity collapses. The market stops behaving like a queue and starts acting like a clearance aisle. Listings age. The next price cut appears before the last yard sign gets straightened. Buyers learn the rhythm fast. End of quarter deal cycles bring the deeper cuts, so people wait. They run the math on a Tuesday, tour on a Saturday, and tell the sales rep they'll be back after month end. Sellers chase them down with new sheets. Lower base, bigger buy down, new bonus if you close in 30 days. It's like a sneaker drop after the hype died. Still cool, just not urgent. Mini payoff. Selena turns into a timing game. Those who price first, close first. Soft launch the discount and you'll still get ghosted. Lead with the real number and the payment support and you'll move the house before your neighbor blinks. Shift to Houston's west side where oil mood swings can still set the tone. Number 9, Katy, Texas. Katy's size was its strength. In a slowdown, it's also the drag. You know the playbook here. Master-planned communities for miles, strong schools as the anchor, and multi-phase expansions that made builders treat the west side like an assembly line. Scale looked safe. More neighborhoods meant more buyers, more amenities, more everything. That logic crushed in a boom. But here's the catch. High rates meet a migration slowdown, and the oil sector mood flickers in the background. When that faucet tightens, weekend traffic drops, and the "we'll take anything clean" mindset evaporates. Katy's advantage, lots of options, turns into a maze where buyers can spend weeks touring and still feel no urgency. Resale now fights new construction on every cul-de-sac. Builders run relentless promos, rate buy-downs splashed in bold, closing cost credits, and bonus upgrades that make older floor plans look tired. If your 2010 layout has a 2-story living room and a segmented kitchen, it loses to the new build handing out a buy-down that hits a payment number buyers can't ignore. Foreclosure levels aren't crisis level, but the added supply nudges buyers into a wait-and-see stance. They watch, they compare, they stall. That caution stretches days on market and forces price trims that would have been unthinkable in the last cycle. It's not panic. Just leverage moving to the other side of the table. Here's how it looks on the ground. A $500,000 resale stacks up nice in photos, but the builder down the street shows a similar square footage with a permanent buy-down that beats the monthly by a couple $100. The math wins, not the nostalgia. You can stage the roses and light the candles, the payment still decides. So the migration trap in Katy is choice overload plus incentives. When buyers can cross-shop 10 nearly identical homes and one of them offers 2 points in appliances, expectations reset downward. That doesn't mean slashing to the studs. It means sellers either price to the payment or get passed over by a flyer taped to a model home door. Sellers who held out in Q1 meet reality by summer. The longer you test a high list, the more your neighbor's discount becomes your comp. By the time you add a credit and a buy-down, you're chasing the buyer you could have had on week 1. Let that sink in. Mini payoff. Katy becomes a pricing tournament. The most transparent listings, clean disclosures, realistic asks, clear concession menus win. The rest learn what DOM really stands for. A bit east, Sugarland faces a different equation. Older wealth, newer math. Number 10, Sugarland, Texas. Sugarland has brand power, but brands can't override payment math. You know the vibe. Established neighborhoods, mature trees, lakes, and cul-de-sacs that scream stability. Higher household incomes kept demand steady and kept sellers confident. The resale market here usually behaves like a well-run HOA. Orderly, predictable, and a little proud of itself. But here's the catch. With fewer out-of-state cash buyers showing up, premium asks wait longer. That fully remodeled kitchen that once guaranteed multiple offers, it still photographs beautifully, but upgrades don't translate one-to-one into higher sale prices anymore. Buyers who used to chase are now counting dollars, not Instagram likes. The new scrutiny is total cost, not just sticker. People are zooming in on property taxes, spiking insurance premiums, and the hidden remodel costs that come after move-in. A roof quote and a pool resurfacing estimate can vaporize enthusiasm in a single afternoon. And appraisal conservatism is back. Lenders aren't blessing aggressive numbers when the comps whisper caution. Deals that would have sailed through 2 years ago now hit friction at underwriting. Research backs the mood shift. Texas home values still sit roughly 17.7% overvalued versus income and rent trends, and higher rates punch the buy box smaller. That statewide cooling is visible on Sugar Land's premium resales. Longer days on market, wider list-to-close gaps, and more concessions baked into contract terms. It's not drama, it's gravity. Here's what it looks like on the ground. Renovated 90s 2-stories, new floors, quartz, updated lighting. Still need price precision to move in under 30 days. Miss the number by even a little, and you drift into week 5 with nice feedback and no signatures. Buyers want turnkey, but they want turnkey at a payment that doesn't make their spreadsheet cry. The migration trap explains why. Those wealthy newcomers set the pricing floor. When that floor disappears, locals negotiate hard. They've watched the comps, they've watched rates, and they're fine walking away if the math doesn't land. That's a different energy than the relocation buyer who had a deadline and a corporate stipend. Sellers are learning fast that list price psychology is 2021 nostalgia. Test high and see turns into a slow bleed. Reduction, then another, then a rate buy down and credits to hit the target monthly you could have led with. It's like bringing designer luggage to the airport and then paying to check it anyway. You still fly, just after extra fees and a mild identity crisis. So here's the thing, Sugar Land stays desirable. Schools, amenities, and stability still pull, but price discipline decides who closes. Lead with the real number, stack sensible concessions, and you move. Chase yesterday's comp, and you collect saves, not offers. That's our map of the battlegrounds. Now, what do you do with it? That's it for today. Don't forget to like and subscribe to the channel for more of the latest updates.